Welcome to Project Blackwood.
Sitting down and looking at the files we've pulled for this deep dive, it is a remarkable contradiction to start with. Because when you look at the evidence, the core financial architecture of this entity, it fundamentally shouldn't exist in its current form.
No, it defies the basic laws of corporate gravity.
Completely.
I want to look right at the apex of their power. We have the data from around 2012 here, and I want to set that right next to the files from late 2025 because the contrast for you, the listener, is just staggering.
The peak is, it's a colossal physical empire.
Undisputed. They operated 6,602 locations globally. They employed 17,000 people. And they generated a massive $9.5 billion in top-line revenue. They were the absolute sovereign of specialty retail.
Right. If you bought a video game anywhere on Earth, you likely walk through their doors to do it.
Yeah.
They own the mall ecosystem. They own the strip center. They dictated the physical distribution of interactive entertainment.
But then you shuffle the papers and look at the reality in late 2025. It's a complete inversion. The core operational reality of this company has effectively evaporated.
The footprint alone is brutal.
The store count is slashed from over 6,600 down to 3,203. The headcount is gutted, literally halved down to just 8,000 employees. And that top-line revenue is in terminal decline, cratering to $3.8 billion.
They lost the dominant market position.
Yeah.
They lost the foot traffic, and they definitively lost the physical market to digital distribution.
And here is the anomaly we have to dig into. The impossible number buried in these recent disclosures.
It's sitting right there on the balance sheet.
Despite that structural decay, despite the total evaporation of their core business model, they are sitting on an astonishing $8.8 billion in cash and marketable securities.
Which makes no sense.
Right. That is the central mystery we have to unravel today. How does a structurally bankrupt mall retailer, a company facing total technological obsolescence, actively losing its primary market, somehow cheat death?
They didn't just survive. They transformed into an $8.8 billion bank masquerading as a chain of stores.
Exactly. Their valuation and their treasury have entirely decoupled from the actual business of selling video games.
We are essentially performing an autopsy on a company that is somehow still walking around with billions of dollars in its pockets. And I think it's important to state up front, there is a profound human tragedy in that survival.
Absolutely.
You have thousands of jobs permanently erased, local communities losing retail anchors, all juxtaposed against this bizarre, deeply ironic financial fortress.
So to understand how they engineered the survival, we really have to look at the original DNA of the company. I'm pulling the earliest files from 1982. And the Genesis story completely subverts the mythology you might expect.
Yeah, if you assume a massive video game retailer was started by a couple of hardcore gamers in a garage who just loved the Atari 2600, the data tells the exact opposite story.
Right, look at the founder backgrounds here. James McCurry and Gary Kusin.
They weren't gamers at all. The pedigree is entirely corporate. McCurry was a consultant for Bain & Company. Carlson was his former Harvard Business School classmate, working as a general merchandise manager for the Sanger-Harris division of Federated Department Stores.
They approached the consumer software market as a clinical optimization problem. They were data-driven merchandisers. And looking at the macroeconomic environment when they opened their first store Babbage's in a Dallas regional mall on Memorial Day 1983, it was a terrifying time to enter the market.
Oh, the timing is wild. The video game industry was in the middle of a catastrophic crash.
Right. The market was flooded with terrible games. You have the infamous E.T. cartridge landfill disaster destroying consumer trust, and industry revenues were plummeting.
But that is exactly why the Bain and Harvard backgrounds matter. They didn't view the 1983 crash emotionally. They looked at the volatile, panicked market and approached it with absolute consulting precision.
They recognized that the incumbent retailers were tied to static inventory models.
Exactly. Their strategy was entirely built around flexibility and labor control. They designed flexible store layouts so they could rapidly swap out gaming platforms. The second consumer data showed a shift in preference.
They constantly updated their product mix based on daily sell-through data rather than just, seasonal guessing.
And crucially, if you look at the operational notes here, they utilized non-commissioned sales staff.
That labor decision is the foundation of their operational leverage, isn't it?
It is. Non-commissioned staff meant they could tightly control their baseline operating costs while maintaining an approachable low-pressure environment. It stood in stark contrast to the high-pressure, commissioned electronic salesmen dominating the era.
They engineered a system designed for rapid iteration. But that highly structured DNA, that absolute obsession with optimizing physical floor space, it planted the seeds for their eventual rigidity. They became fundamentally philosophically tied to the physical transaction.
Right. And it also meant they had immediate credibility with institutional capital. Check the 1983 funding round.
Yeah, I'm looking at it. They secured a $3 million credit line from Ross Perot in exchange for a one-third ownership stake
$3 million in 1983.
from one of the most famous and ruthless businessmen in America.
This wasn't a bootstrap operation.
Yeah.
It was heavily institutionalized from day one. And taking institutional money of that magnitude changes the biological clock of a company.
You aren't just trying to build a sustainable local business anymore.
No, you are legally and financially obligated to build a scalable, exponential growth machine. And the velocity of their expansion reflects that immense pressure. By 1986, just 3 years after opening their first door, they hit $10 million in revenue and broke even across a 23-store chain in Texas.
They realized very quickly that console software, specifically Nintendo games by around 1987, was the cash cow. They pivoted heavily into that ecosystem, driving earnings to $1.16 million on $29 million in sales.
That momentum culminates in a July 1988 initial public offering at $13 a share, raising $20 million. Ross Perot exits his equity position, cashing out perfectly.
It looks like a flawless textbook corporate triumph.
Until the macroeconomic data shifts under their feet in the early 1990s, the aggressive growth phase masks a growing structural vulnerability.
Let's trace that. They keep scaling through the 16-bit console wave, the Super Nintendo and the Sega Genesis eras. By 1994, they execute a massive merger with B. Dalton spin-off, software, etc., forming a huge holding company called Neostar Retail Group.
Suddenly, they control 715 stores.
Yeah.
They look like an unstoppable juggernaut.
But if you slide down to the margin notes in the fiscal year ending January 1996, the illusion just shatters.
It's brutal. The top-line revenue is massive for the era, $513.5 million. But the net profit tells the real story.
It's barely a rounding error. $120,000 net profit on over $500 million in sales.
That means their profit margin was effectively zero.
They were moving incredible volume, but something was structurally eating their lunch before the games even hit the shelves.
Two massive macroeconomic forces collided to crush them simultaneously. First, the hardware cycle. The industry was undergoing a brutal transition from 16-bit cartridges to 32-bit CD-ROM consoles, primarily the original Sony PlayStation.
Right.
Neostar's highly optimized supply chain suddenly became a liability. They were sitting on warehouses full of outdated, expensive cartridge games that had near zero consumer demand overnight. The inventory obsolescence was staggering.
And the second force was the arrival of the big box predators, Walmart, Toys R Us, Target.
The Titans.
These massive conglomerates realized that video games were the ultimate driver for adolescent and parent foot traffic. So they began using hit video games as loss leaders.
Let's break that down for a second. A loss leader is a pricing strategy where a store intentionally sells a product below its market cost to stimulate other more profitable sales.
Right.
Walmart didn't care if they lost $2 on every copy of Madden they sold because that same customer would buy a bicycle, a week's worth of groceries, and a pack of batteries while they were in the store. The video game was just the bait.
But for Neostar, for these specialty stores, video games were the only thing on the menu.
Exactly.
They couldn't compete with a loss leader. If Neostar matched Walmart's price, they bled cash on every transaction. If they held their prices to protect their margins, the customer simply drove to Walmart. The disruptor was entirely disrupted.
Which leads to a historical revelation that modern market participants largely forget. The company actually died.
Let that sit for a second. The original corporate entity collapsed under the weight of those margins.
In September 1996, Neostar Retail Group filed for Chapter 11 bankruptcy protection. They literally failed to secure the operational financing required to stock their own shelves for the holiday season.
The original incarnation of this company, built by Bain and Harvard alumni, backed by Ross Perot, ended in total, absolute failure. The equity was wiped out.
The first corpse is on the table. And if the timeline ended there, the brand would just be a nostalgic footnote in retail history, another casualty of Walmart's 1990s expansion.
But a dead business model still leaves behind highly valuable real estate leases, brand awareness, and physical infrastructure, which brings in the vulture capital.
Pulling the November 1996 files.
Yeah. An investor group led by Leonard Riggio, the chairman of Barnes & Noble, swoops in. He buys the bankrupt assets of Neostar for absolute pennies. Just $58.5 million dollars for the entire infrastructure of a company that was generating $500 million in sales a year prior.
Riggio executes a masterclass in ruthless retail efficiency. Because he had no emotional attachment to the founder's vision, he could amputate the decaying limbs of the company immediately.
He closed roughly 200 underperforming, expensive mall locations right out of the gate.
He pivoted the real estate strategy toward much cheaper, high-visibility strip malls. And in 1999, he launches the unified brand name that changes the trajectory of the industry, GameStop.
The financial engineering Riggio pulls off here is dizzying. In October 1999, he sells this newly stabilized GameStop entity to his own broader corporate umbrella, Barnes & Noble, for $215 million.
Wait, look at that math. He bought it for $58 million, cleaned up the balance sheet, and flipped it to his own public company for a massive personal gain just 3 years later.
It's wild. And Barnes & Noble utilizes that momentum to make an even more critical acquisition the following year. In June 2000, they acquire Funko Inc., the operators of Funkoland, for $161.5 million. They merged the Babbage's infrastructure, the new GameStop brand, and Funkoland together.
Now, on the surface, buying Funkoland just looks like a real estate play to acquire more physical stores.
Yeah.
But Funkoland possessed a piece of operational DNA that Babbage's lacked, something that would define the next 2 decades of the industry.
They had pioneered a massive, highly systematic used video game ecosystem.
They had cracked the code of the secondary market.
By 2004, Barnes & Noble spins this newly forged gaming behemoth out into a totally independent, publicly traded entity. GameStop sets its sights on total market domination, leading directly to the October 2005 mega merger, the acquisition of their largest specialty competitor, Electronics Boutique, or EB Games.
For $1.4 billion in cash and stock.
I have to pause and look at the sheer audacity of that 2005 decision. They drop nearly $1 billion in pure cash outlays to acquire physical retail locations.
Right.
But in late 2005, broadband internet is proliferating rapidly. Microsoft is launching Xbox Live. The PC gaming market is clearly signaling that digital downloads are the future. Why on earth would management authorize a $1.4 billion expenditure to buy more physical stores when the digital horizon is visibly approaching?
It looks like pure hubris, in retrospect, the equivalent of Blockbuster buying more physical storefronts the year Netflix streaming goes live. But the true prize of the EB Games acquisition wasn't the physical real estate, and it wasn't the top-line revenue aggregation.
It was margin engineering.
Exactly. If we break down their unit economics benchmarking matrix from the mid-2000s, the brilliance of the strategy becomes terrifyingly clear. We have to look at what they were actually making on different categories of products.
Start with the hardware. When a customer walked in to buy a brand new console, what was the profit profile?
If someone bought a new Xbox 360, GameStop's gross margin was incredibly thin. In 2004, their hardware margin was just 4.1%. By 2005, it bumped slightly to 6.1%. They were making pennies on the dollar for the most expensive items in the store.
Hardware is a low-margin necessity. It exists solely to trap the consumer in your specific retail ecosystem. Now look at the new software, the hit games wrapped in shrink wrap.
New software yielded a 21.4% gross margin. Significantly better. It pays the rent, keeps the lights on, but doesn't build an empire.
Which brings us to the third category. The Funkoland secret weapon applied at scale, the used games.
The gross margin on pre-owned software and hardware was 45.3% in 2004. After they merged with EB Games in 2005 and applied their systems to EB's inventory, it jumps to 47.4%. By 2009, it hits 48.0%.
Let's translate the mechanics of a 48% gross margin for a second.
Yeah, please.
They developed a proprietary point-of-sale algorithm that effectively extracted 48 cents of gross profit out of every single dollar of used product revenue. If a consumer bought a brand new $60 game from Walmart, Walmart made perhaps $12. But if that consumer played the game, beat it, and traded into GameStop for $20 in store credit, GameStop's algorithm would immediately price that used disc at $55 and put it back on the shelf.
We've all been there, right?
Yeah.
You bring in a stack of 5 games you spent $250 on just 6 months ago, and the clerk scans them, looks you dead in the eye, and offers you $13 in store credit or $8 in cash.
It was infuriating.
It was infuriating as a teenager. But looking at the data, that infuriating, borderline insulting transaction was the exact engine powering a multi-billion-dollar empire. The algorithm managed that pricing dynamically across thousands of stores, adjusting trade-in values daily based on local demand and national inventory levels.
GameStop effectively weaponized the trade-in ecosystem to fight back against the big box retailers that killed Neostar. Walmart, Best Buy, and Target fundamentally lacked the operational infrastructure to process trade-ins.
They didn't have the point-of-sale appraisal algorithms. And most importantly, they didn't have the specialized labor model, where clerks were explicitly trained to negotiate trade-ins, push store credit over cash to trap the capital in-house, and aggressively upsell pre-owned inventory over new copies at the register.
By acquiring EB Games, they didn't just eliminate a competitor. They applied this hyper-efficient, localized arbitrage engine to thousands of new locations. They cornered the global secondary market.
The 48% margin insulated them from big-box competition for a decade, generating unparalleled cash flow.
It was a structurally impenetrable monopoly, which pushes us toward the absolute peak of their physical power, and the moment the rot truly begins to set in.
Let's pull the 2012 disclosures.
I have them here. And the numbers project absolute invulnerability. They report a historical peak revenue of $9.55 billion. The physical footprint hits its absolute zenith with 6,602 locations. They are a global behemoth spanning North America, Europe, and Australia.
But 2012 is also the year the psychological trap closes on management. They mistake past momentum for future invulnerability. If we act as forensic accountants and look past the top-line revenue, we see the cracks forming in the foundation.
Buried deep in that exact same 2012 filing is a glaring, massive red flag. Alongside the $9.55 billion in revenue, the company quietly recorded a staggering $680.7 million impairment charge.
That impairment charge is the sound of the ice cracking beneath their operational model.
The filing breaks this down into $627 million in goodwill impairments and $44.9 million in trade name impairments. For anyone not steeped in corporate accounting, how do we translate what management is actually admitting to here?
A goodwill impairment is essentially an accounting confession. Think of it like buying a house.
Yeah.
You might pay $500,000 for the physical house, but you pay an extra $200,000 just because it's in a highly desirable neighborhood. That premium is goodwill.
Right.
It represents brand value, customer loyalty, and expected future earning power. When GameStop bought EB Games, they paid a massive premium based on the belief that physical retail dominance would last forever. But by writing down $680 million of that goodwill in 2012, management is telling institutional investors, the neighborhood is decaying. The value of our brand and our future earning power is severely, permanently damaged.
Because the digital disintermediation they ignored in 2005 was finally destroying their physical retail model.
Look at the broader technological landscape by 2012. The PlayStation Network, Xbox Live, and Valve's Steam platform on PC had fully matured. Game publishers realized they no longer needed a physical middleman.
They could sell a digital copy of a game directly to the consumer's hard drive, keeping 100% of the revenue, entirely cutting GameStop out of the transaction.
And for the physical copies the consumers still wanted, Amazon had captured the logistics advantage, delivering games to doorsteps with prime shipping faster and cheaper than a trip to the local mall.
The digital shift meant the 48% used game margin was doomed. You can't trade in a digital download.
You can't.
So that $9.55 billion peak was entirely illusory. The foundation was rotting. And that realization triggers absolute panic in the boardroom. The touchline from 2013 to 2018 is a frantic, desperate pivot.
Management realized they needed a lifeboat, so they started throwing immense amounts of capital at anything that wasn't a physical video game disc. They engaged in severe strategic drift.
The acquisitions become bizarrely disconnected from their core competency. In November 2013, they acquire Spring Mobile, an AT&T wireless retailer, and Simply Mac, an Apple-certified retailer. They try to abruptly diversify into cellular contracts and consumer electronics.
And then, in June 2015, they drop $140 million in pure cash to acquire GeekNet, the parent company of ThinkGeek. They actually outbid Hot Topic for it, just to secure a high-margin pop culture collectibles portfolio.
The desperation here is palpable. You have a corporate culture and a logistical infrastructure perfectly designed to buy and sell used video games, suddenly attempting to manage thousands of AT&T phone stores.
Selling long-term cellular contracts is a completely different regulatory, operational, and customer service reality. It requires a completely different labor model.
And the data shows exactly where the operational efficiency broke. The human and financial toll compounds rapidly. By 2017, employee bloat hits an absolute peak of 23,000 workers globally. But the margins are severely compressing across the board.
Look at the technology brand's cellular segment. It becomes a massive liability. In 2017 alone, the cellular segment generated a catastrophic $316 million loss.
They tried to force cell phone contracts through the exact same operational gears calibrated for used games. It destroyed immense shareholder value and crippled their cash flow.
Which forces a massive divestiture. By January 2019, they were forced to dump the Spring Mobile division, all 1,289 AT&T stores, selling it off for $735 million, just to stop the bleeding.
But the cellular disaster was only a symptom of the deeper existential crisis. The core gaming business was dying.
Which brings us to the boardroom discussions of 2018 and early 2019. The situation had degraded from panic to outright begging.
In May 2018, CEO Michael Mahler resigns after just 3 months on the job. The board immediately initiates a formal review of strategic alternative.
That is polite corporate speak for, we need to sell this company immediately before it goes to zero.
They went to the private equity titans, firms like Sycamore Partners and Apollo Global Management. The goal was to execute a leveraged buyout, take the company private, and hide the decay from the glare of the public markets while they attempted a brutal restructuring.
Let's explain the mechanics of a leveraged buyout, or LBO, because it's critical to why this failed.
Yeah, go ahead.
In an LBO, a private equity firm buys a company using a massive amount of borrowed money, but they use the target company's own assets and cash flow as the collateral for the loan. It's like taking out a mortgage on a house, but forcing the house to pay its own mortgage.
Exactly. Private equity firms specialize in distressed assets. They buy dying companies, load them with this new debt, strip the valuable assets for parts, fire thousands of people to cut costs, and extract the marrow before taking the company public again or liquidating it.
But in January 2019, GameStop had to publicly abandon its efforts to sell itself. The private equity firms walked away because they couldn't find commercially acceptable financing for the LBO.
Think about how bad your books have to be for vulture capitalists to walk away. GameStop's existing structural debt, combined with the terminal, irreversible decline of physical game sales, made the math impossible. The cash flows were dropping so fast that banks wouldn't even lend the money to facilitate the buyout.
The company's debt was effectively radioactive.
It marks a profound tragedy for the organization. They were trapped in the public markets, entirely exposed, destined to slowly bleed out quarter by quarter. Comparable store sales plummeted nearly 20% in Q4 2019. The physical locations were becoming ghost towns.
Which brings us to the anomaly, the exact moment where the laws of financial gravity simply stopped working.
We have to map the true bottom of this descent first to understand the scale of the reversal.
Right, the investigation reaches April 2020. The global pandemic has forcibly locked the doors of almost every physical location they operate.
The stock is trading at an abysmal split-adjusted price of between 88 cents and $1.43. To the institutional world, the corpse is entirely cold. They are universally viewed as the next blockbuster video. The narrative is finished.
But an agitator enters the ecosystem and disrupts the institutional consensus.
I'm pulling the letter from November 16, 2020. An investor named Ryan Cohen, the manager of RC Ventures and former founder of Chewy, had quietly accumulated a 12.9% equity stake in the company. He issues a hostile, brutally direct public letter to the board of directors.
The venom in his assessment of leadership is striking. Read the exact phrasing.
Quoting Ryan Cohen directly, "A board that has overlooked years of digital revenue opportunities and presided over massive value destruction without assuming full accountability. We want GameStop's leaders to do their jobs and implement a strategy for bringing the company into the 21st century."
Massive value destruction is an entirely accurate assessment. He demanded they immediately close underperforming stores, cut the bloated executive compensation, and pivot aggressively to e-commerce.
But while his arrival provided a strategic catalyst, it ignited something far darker, far more chaotic in the underlying plumbing of the financial markets.
We have to examine the short squeeze data. Because while Cohen was demanding operational changes, Wall Street hedge funds had placed a colossal, highly leveraged bet on GameStop's imminent bankruptcy. The short interest float was sitting at over 140%.
That specific number, 140%, is where the system breaks down.
A standard short sale is a relatively simple bet against a company. An investor borrows a share of stock from a broker, sells it into the market at the current price, and hopes the stock price falls. Later, they buy the stock back at the cheaper price, return the borrowed share to the broker, and pocket the difference.
But 140% short interest means that hedge funds had borrowed and bet against more shares than actually physically existed in the public float.
Which begs the question, how is that mathematically possible? How do you sell something that doesn't exist?
Through aggressive, systemic, and highly reckless financial practices known as rehypothecation and naked shorting.
Think of rehypothecation like this. I borrow your car and I sell it to someone else. But then that buyer lends it to a third person who sells it again to a fourth. Suddenly, three different people hold a piece of paper claiming they own the exact same car.
Wall Street clearinghouses and prime brokers were doing this with shares of GameStop. Wall Street was so arrogant, so absolutely certain of GameStop's inevitable bankruptcy, where all those short positions would become 100% tax-free profit, that they over-leveraged themselves into an inescapable mathematical trap.
And the retail investor uprising recognized the trap. Let's trace the culture and the events of January 2021. You had a massive, decentralized collective of retail investors gathering on social media forums, specifically the Wall Street Bets community on Reddit.
These weren't institutional analysts. These were everyday people, heavily gamified by zero-fee trading apps like Robinhood, sitting at home during a pandemic. They looked at the public data and saw that 140% short interest.
They realized the structural vulnerability of the hedge funds. If the retail collective simply bought the stock and stubbornly refused to sell, the price would start to rise. As the price rose, the hedge funds would face margin calls from their brokers, forcing them to buy shares at any price to cover their losing bets.
But because they had shorted 140% of the float, there wouldn't be enough real shares to buy.
The result was an absolute unprecedented rug pull for Wall Street, a cascading liquidity crisis.
The stock erupted.
It rocketed to a split-adjusted all-time high of $86.88 on January 27, 2021. Pre-split, that was nearly $500 a share for a company that was trading under $1 mere months prior.
Trading volumes exploded into the hundreds of millions daily. The volatility was so violent that major clearinghouses faced insolvency, forcing brokerages like Robinhood to actually shut off the buy button for retail investors, allowing them only to sell.
It became front-page global news, triggering congressional hearings.
But here is the critical analytical distinction that gets lost in the populist narrative of David versus Goliath. This massive explosion in market valuation had absolutely nothing to do with the company's operational reality.
Right. They weren't suddenly selling millions more video games. The unit economics were still dying. Total operational revenue for fiscal 2021 actually dropped to around $5 billion. The physical stores were still largely empty. The 48% used game margin was still vanishing into the digital ether.
The squeeze was a pure capital market anomaly, a glitch in the financial matrix driven by market mechanics, options leveraging, and retail momentum, entirely divorced from operational success.
But this is exactly where the story shifts from a cultural meme into a brilliant, ruthless corporate masterstroke.
Management's response to the squeeze is a masterclass in survival. Instead of just watching this meme stock moment pass, instead of waiting for the stock price to inevitably fall back to earth, GameStop weaponized the inflated equity.
They capitalized on the retail frenzy by issuing new stock directly into the market to raise capital.
The mechanism they used is called an at-the-market or ATM equity offering. In a traditional stock issuance, a company hires an investment bank, sets a fixed price, and sells a large block of shares to institutional buyers.
An ATM offerings is different. It acts like a valve. The company slowly releases new shares directly into the open market at whatever the current wildly inflated market price happens to be.
They siphon the speculative energy of the retail investors directly into the corporate treasury.
And the sheer volume of capital they extracted is staggering.
Look at the sequence in these filings. In April 2021, they activate an ATM offering, selling 3.5 million shares into the squeeze to generate $551 million in pure cash.
Just a few weeks later, in June 2021, they execute a second ATM, offering 5 million shares sold to raise another $1.126 billion.
And they recognize this was a repeatable strategy. Fast forward to September 2024, they drop a third major ATM offering, selling 20 million shares to raise another $400 million.
They functionally minted billions of dollars out of thin air. They diluted their own shareholders, but those shareholders were so ideologically committed to holding the stock that the price didn't collapse.
And what did management do with that first massive infusion of liquidity? This is the pivot point of their modern survival. I'm looking at the April 30, 2021 filing, the voluntary debt eradication.
The company uses their newly minted cash to voluntarily redeem $216.4 million in 10.0% senior notes that were due in 2023. They instantly wiped out their long-term corporate debt.
In one stroke of a pen, they transitioned from a distressed brick-and-mortar retailer on the verge of insolvency, a company with debt so toxic that private equity wouldn't touch it 2 years prior, into a highly capitalized, debt-free financial fortress.
But we have to bring this investigation back down to the ground level, because while the holding company became this multi-billion-dollar fortress, the operational reality on the ground was a bloodbath.
The balance sheet was saved, but the physical company was gutted to achieve it. Let's quantify the human tragedy embedded in these numbers.
We discussed the peak in 2012 and the desperate bloat of 2017 with 23,000 employees.
Look at the operational scale matrix for 2024. The locations were ruthlessly slashed from 6,602 down to 3,203. The employee count was aggressively pared down to just 8,000 people globally.
That is 15,000 jobs, 15,000 livelihoods, careers, and local economic inputs permanently erased in the pursuit of corporate stabilization.
Behind the triumphant headlines of the short squeeze, behind the heroic narrative of retail investors beating Wall Street hedge funds, thousands of store clerks, district managers, and warehouse workers lost their jobs.
The footprint shrank drastically as they abandoned entire geographic markets and walked away from leases. The companies survived, but the people who built the physical empire did not.
Which brings us to the ultimate reality check in the Q3 2025 filings. The transformation is complete, but the result is deeply strange. Remember the algorithmic moat, that impenetrable 48% gross margin on used games that built the empire in 2005.
The Funkoland secret that gave them their power.
It has essentially vanished from public view. GameStop has completely stopped reporting explicit used game margins in distinct isolation in their filings. They've blended the data into broader, opaque categories to mask the decline. They are increasingly hiding behind the collectibles segment.
Collectibles. Funko Pops, Pokemon trading cards, branded t-shirts, plush toys.
Exactly. In 2024, collectibles increased to $270.6 million in a single quarter, making up nearly 29% of their total revenue. They transitioned from the definitive hub of interactive entertainment to a sprawling novelty gift shop.
Total top-line revenue for 2025 has plummeted down to $3.8 billion. They're selling half the volume they moved a decade ago.
Yet, despite selling half the product, despite gutting their workforce, despite abandoning half their real estate, they sit on an aggregate cash equivalents, and marketable securities position of over $8.8 billion.
If I'm reading the culmination of this data right, what are they exactly?
Yeah, they are no longer a retailer. Not fundamentally. The retail operation is merely a legacy mechanism. They are an $8.8 billion investment fund, a treasury entity managed by Ryan Cohen that just happens to have a dying retail appendage attached to it.
They leveraged a generational market anomaly to secure enough cash to entirely outlast their own operational irrelevance.
It is the ultimate paradox. I want to pause and reflect on the alternate timeline here, the what-if scenario. What if Sycamore Partners or Apollo had actually found the bank financing for that leveraged buyout back in January 2019?
If private equity had secured that debt, the company would have been quietly taken private. The physical footprint would have been brutally stripped for parts, the remaining profitable real estate leases liquidated, and the remains bundled and sold off into complete obscurity.
The 2021 financial anomaly, the short squeeze, never would have occurred because the company wouldn't have been publicly traded. Retail investors wouldn't have had a public ticker to rally around. Hedge funds wouldn't have been caught in the 140% trap.
And that $8.8 billion cash hoard simply wouldn't exist. The company would have died the quiet, predictable death of a legacy mall brand.
Which serves as a broader, vital warning for the modern market. If you look across the landscape today, there are other legacy companies showing these exact same structural warning signs.
Massive physical footprints, shrinking core markets due to technological disintermediation, and crucially, attempting to survive through financial engineering, brand nostalgia, and equity dilution rather than actual sustainable unit economics.
They are coasting on historical momentum, hoping for their own anomaly instead of fixing the core business model. But lightning rarely strikes the same place twice.
The fundamentals always eventually reassert themselves. Even with billions of dollars sitting in a treasury account, a company still has to figure out what it is actually providing to the world.
This has been Project Blackwood.
Consider the inherent fragility of any system that values infinite growth over stability. What does it say about our collective obsession with progress and market mechanics when a zombie retailer, entirely decoupled from its operational reality, becomes vastly more valuable than a thriving functional business? Keep looking at the numbers, they never tell the story you expect.